Right. I guess we'll figure out if we're live. We'll try this random music. We'll see. We'll see if we like it for a second.
Did you record this music, Seth?
I did. This is my my evening routine is recording random music. All right. Let me go live in all the places. You can do the same.
Yep, I have seen some eyeballs, so we're getting some people. If you're with us, go ahead and drop where you're from in the chat. That would be one of our next slides here.
Indeed. The we want to know where everybody's in from. Throw it in the chat as we'll get situated here. Let me check a couple other things, make sure it's posting correctly.
It's live on my Facebook correctly, Seth. So
yeah, yours has not been the problem, but mine has for sure been the problem. So we'll
wait
see.
A second. Did you just say that you're the problem?
I am the problem. I am for sure the problem. All right, let's see if this thing is going live or not. I don't think it is. How do I fix that? Try it one more time here.
Yeah,
all right, we'll give it another second. And are people putting in the chat yet? Are we getting anybody?
We got a couple. We got an Idaho. We got Baltimore. We got a couple of folks.
I've got Idaho in the house. There you go. All right. Well, this is not live, so somehow there's something wrong with my Facebook. It's streaming on yours, not on mine. I guess we'll deal with it. So okay, enough of this acoustic music here. Katrina, welcome. You're sitting down. You are still not fully healed. I don't want to hear. I don't want all the gory details, but tell everybody: are you on the mend? Are you going to live?
I am going to live. I'm going to live. Hopefully, in about 2 more weeks, I'll have skin again. And that skin is really an important part of your body.
Yeah, so. It is. So I'm glad you're on the mend. It's that's been a rough one for sure. Everybody, Katrina had a skin burn a couple weeks ago, and I would not wish that on anybody. Incredibly painful, and you're experiencing that firsthand right now. So,
but here's the good news. Walking about once an hour is really good for it. So guess whose streak has not ended?
Yes, your streak has not ended. Hey, do us a favor. Put in the chat if there are any particular topics that you are wanting to make sure that you hear about today. By the way, there's a chance that we won't cover it, and we'll hear it, write it down, and maybe it's something we'll cover in the future. This is definitely going to be a few of the, as Katrina and I teach through our brokerage and as we teach around, when we start to hear some consistent themes of mistakes that we watch people making to get their finances in order inside of their business and personally, those are the topics that we're bringing up here. So we're going to go through 10 tips on the business side and 10 tips for your personal finances. And we hope that there's value for everybody. But if there's some things that you want to make sure get covered or want us to address, I'd love for you to put that in the chat. And now is where I see the comments. So yes, hello from all of you wonderful people. So all right, throw those in the chat if you've got questions and you want those addressed. We would love to do it. Otherwise, let's dive in here. So discussing business finances. We're going to organize these as sort of mistakes and then solutions that we've seen. I mean, Katrina, start us off with one of the very first things that we teach agents when we're sitting down doing kind of agent financials is this idea of you are organizing your accounts and your funds incorrectly. What do you notice there?
Yeah. So for many people who get into the real estate business, they're coming from a JOB where they get a direct deposit every other week, and that's their money. That's their money. And they have one account, they have a savings account, a checking account. And then they get into real estate and they confuse the money that they have with the same as what they had with the JOB. So they continue to have just personal checking, savings, and credit cards. And it's a pretty big mistake that most agents, when they start out with, that they commit.
Yeah. And so if you want to take a screenshot or take a picture, this would be the slide to take a picture of. And we'll send all the slides out to you. You guys can have the recording. But on the left side, you see sort of business accounts and credit cards. On the right side, you see personal. But walk them through what are the 6 accounts that we'd recommend everybody have, and then what are the 3 credit cards?
Yeah. So for business and personal, you should still have checking and savings. They just simply need to be separate. And honestly, if you're just starting out and you're like, I don't have all of these other pieces, like for me to get an LLC and a business and all of that, even if you just simply go with your personal banking system and add a couple more accounts, that can be a really easy way to start. So personal savings, personal checking, business savings, business checking, within tax savings. We'll get into this more in one of our mistakes, but the idea that it's not all your money. When you got a paycheck, some of your money came out for taxes. And when you get paid in real estate, you need to set money aside for taxes. And then on the personal side in that, your investment account, where is your money going that is, whether it be, kind of that like truly investing in the market, or it might just be a high yield savings account that you're saving up money so that when an opportunity to buy an investment property or going on a syndication or something that comes up, you've got some liquid assets. And then credit cards for the business and personal. We have down here the business credit card and the owner credit card. And we're going to go over a little bit later why we have those two separate. Why would you have two credit cards? So stay tuned for more information on that.
Yeah, it's man, nonetheless, if you were making a goal like right now as you're kind of getting into the getting into your list of to-dos before the end of the year, this would absolutely be a great one to do, is make sure that you have these accounts set up. This is sort of a way that we use November and December to get things in order for the next year. So take a picture of that. Those are the accounts we want. And this is obviously, even though we're going to mention Dave Ramsey, this is totally not Dave Ramsey approved. We literally in our first slide was like, you should have credit cards. So we're probably making mistakes already. Okay. All right. Mistake number 2, not setting aside for taxes. I mean, Katrina, you mentioned a minute ago, like many people, when they get into real estate, are used to having a job. And in other words, they're used to being a W-2 employee where somebody else did the thinking for you. And you kind of gripe at the HR department. But the good news is somebody else did the thinking for you and the government took their money out ahead of time. And then we'll meet people in the real estate industry or other self-employed fields where they've been self-employed for 3 years. And when you talk to them, they're like, man, the IRS sucks. I'm 3 years behind on my taxes. Like, how'd you get 3 years behind? Well, I've been in business 3 years. This happens a lot. So setting aside for your taxes, this is no joke. The IRS is your biggest business partner. They are the biggest expense that you have. And you do not want to get on their bad side. So how do you do that? Katrina, walk us through kind of what these options look like.
Yep. So there's two ways to pay the IRS. You can pay quarterlies, or you can have money taken out with a salary withdrawal. For most agents who are kind of on the newer end, they're not going to be an S corp. They're not paying themselves a salary. So for those people, that's paying quarterlies, and you want to have part of your commission deducted, just pulled out and put into a separate account. Just like when you got that W-2 paycheck, it said you made X amount, but your deposit was only Y because part of it was set aside for taxes. It's the same thing. And then you just pay quarterly. When it comes to once you're a bigger business and you're paying yourself a W-2, you might have other employees, you absolutely can have it withdrawn just like you did when you had the regular JOB from a biweekly or monthly paycheck.
Yeah. So the biggest question we'll kind of get right off the bat is like, well, how much should I set aside? And people will think the answer to that is, well, what's my tax rate? They may or may not know that answer. And then they think, well, I should take all the income I made and set that amount of the tax rate aside. And what you're not accounting for in that is the fact that you are going to have some business expenses. So if you had a $10,000 commission and you were in the 30 or even 40% tax bracket, you might think, golly, do I really have to set aside $3,000 or $4,000 for taxes? But what you're not taking into account is the fact that there are going to be some write-offs inside of the business naturally. So the amount of taxable income that you haven't even calculated yet is going to be toward that you'll calculate later on in the year. So the rule of thumb that we would use if you don't have a more exact figure is plan on 20%. Plan on 20%. And if you figure out you can go a little lower, awesome. But use that as a ballpark for right now.
And something that we do for some of the agents at the brokerage that Seth and I run is we actually, when we do direct deposit, we'll direct deposit to 2 separate accounts for them. Yeah. So for anyone who works with us, we're happy to do that. Otherwise, you can always ask your brokerage if they would do that. That way, just like with that paycheck, you never saw the money, you don't see the money going into your personal checking account, and that can be very helpful.
Which really goes back to the whole statement before of have these separate accounts. All right, mistake number 3. Not setting up an LLC. This, by the way, factors in a little bit to that prior comment of how taxes work. But mistake number 3 that we see is not setting up an LLC. And here would be, we're not giving tax advice. We're not giving legal advice. And here's the steps that I would take. Here's the steps I did take. And unless you figure out that you get better advice, this is what you might want to look into. So one, if you are solo, right, meaning you're not a husband and wife partnership, there'd be something slightly different there. But as just a solo agent getting into the business, as soon as possible, what we would recommend to our kids, our colleagues, agents at our office is go set up a single member LLC. And run your business through here. And then what we find most people do, and when we listen to tax advisors give advice, the most consistent advice that we hear is set it up to be taxed as an S corp. So take an image of these two, picture of these two things, go run it by somebody smarter and more professional that does this for a living, but ask them the question, hey, would it make sense for me to be set up as a single member LLC? And would it be wise to be taxed as an S corp? Have those conversations. Anything you want to add to that?
That's perfect.
It's not as hard as people think.
It's not hard to set up an LLC. It's not hard to get that all set up. What is harder is making sure that you are asking for the right advice from the right people. So go find that CPA who's going to help you with all of these pieces. They'll help direct you.
Yeah, absolutely. All right. Mistake number 4, they don't have an initial capital contribution to reserves to fund their business expenses. So it's like the number of people that get into real estate because there was a downturn in the economy, or there was a government shutdown. They lose or quit their job, and they're like, real estate seems easy, and there's such a low barrier to entry, and so they come in on fumes into real estate. Even though if they were looking at another business, they'd literally be talking about taking out an SBA loan to fund the business. You don't need to take out a loan to fund a real estate business, but if you come coasting in on fumes, you're going to have problems. So Katrina, how would you, if you were talking to a new agent or talking to somebody who maybe is undercapitalized, what would you tell them?
That there's in starting a business, there are expenses. You're going to have immediately, you're going to spend a couple grand. And if you don't have that couple grand to spend, you are now shooting yourself in the foot and stunting the future growth of your business. It's, the idea of there's seed that you sow and seed that you eat. There's bread, and that if you don't have enough seed to sow and you're eating all of it, next season, you're not going to have a harvest. So understanding that just in life overall, there's the seed that you eat and there's the seed that you sow. And before you get into real estate, making sure that you've got seed to sow into the business. And same thing at home, that people will get in and think, you need to have reserves in your personal accounts and in your business accounts, and having that 6-month runway, because to be completely honest, real estate is one of the industries where there's the opportunity to make a lot of money, and chances are high, unless you've got somebody immediate, you're not going to get paid for 3, 4, 5 months sometimes starting out in the business. So getting it really ramping up and having that money in the account so that you can then invest in your business.
Yeah, real estate can be a tremendous industry, and it can be a tremendous industry for somebody to start out part-time. I think one of the challenges that I noticed, and my wife is in real estate, and my wife started in real estate before I did. And Katrina, we've got a lot of ladies in the brokerage. Here's a theme that I see, and I don't even know. I don't know if it's unique to this, and I might be putting my foot in my mouth, but I'm going to say it anyways. Sometimes what I will hear is, "Oh, my partner doesn't mind me being in real estate. As long as it doesn't cost any money, as long as it doesn't take anything." I'm thinking, they're not viewing this like a business for you, are they? They're thinking of this like a hobby, and they don't mind a hobby. They don't care if you have a real estate business or you play pickleball, as long as the costs aren't too high. And I'm thinking, if they had any idea what was possible running a real estate business like a business, they would want to invest in this too. Mm-hmm. And we're going to talk later on, probably one of the last personal mistakes that we see is couples or families not getting on the same page. But the line at the bottom of the screen right now, make cuts at home to fund your business. I think every one of us has to realize that. And if you make decisions in life together with somebody else, you got to have these hard conversations now and be on the same page.
And so frequently people don't want to say no at home.
Yeah.
They don't want to say, no, yes, we are used to going to Mexico to an all-inclusive, but this year we're going to do a staycation. They don't want to say those things.
Yeah.
And as a result, they're actually stealing from their family's legacy, because tightening your belt today will allow you to make so much more money and have so much more of an impact tomorrow.
Yeah, absolutely. So, all right, mistake number 5, not operating on a plan. A plan in the business world, we call it a pro forma. That's just the phrase for it, right? A pro forma business plan or a pro forma budget. It's operating on a plan. And what this would look like is, imagine you're deciding to get into real estate. You actually work out a projection into the future of, here's what my income and my expenses are going to look like. A lot of times people, this is the people that don't do this are the people that then have no conversation about needing to fund 6 months of that in reserves. Then we think about having it in all things, kind of a best case, a probable, and a worst case scenario, walking through what you think this will actually look like. And make sure that you don't reward yourself, right? Like you have one closing and then you go lease a BMW. We've had this happen. Yes. I mean, this is the crazy way realtors think, especially is that they get a little bit of success and then they totally start to burn out the expenses. We want you to underestimate your income, and we want you to overestimate your expenses on your budget to make sure that you actually can make this work.
Yeah, I was just speaking with an agent who vastly undervalued how much income they thought they were going to make, average sales price, etc.
Yeah.
So they've hit their GCI goal, even though they have not hit their unit goal. And that's a really great way. You want to be bearish when it comes to how much money do you think you're going to make. That way, when things are really good, you're not basing it upon that pie in the sky goal. You're based upon, this is what I think actually realistically will happen.
Yeah. Yeah. I love it. All right. So mistake number 6, not spending or investing enough on or in their business. And this is the one where we start to get kind of nerdy, right? Referencing MREA, which stands for Millionaire Real Estate Agent. That's a book that Gary Keller wrote. I happen to have it right here. I mean, this is the book that we're referencing when we say that. And Katrina, there's a bunch of numbers in that book. I don't know if the next slide. Yeah, I mean, there's a bunch of numbers, right? Well, let me just kind of go back here where they don't need to see all of that for right now. It's like there's kind of 2 main ideas to think about. One is cost of sales, and then the other one is this expense number. And usually when we're talking with an agent, we're like, yeah, there's a lot of numbers you need to look at, but there's really only a couple big expenses. How would you have agents think about that?
So I find that there are many agents who are overspending in their business, and especially for more of the solo agents, younger agents, many who are underspending in their business. And that's mostly because they're overspending at home. They need to have that extra profit. So I'll hear somebody who say, I could really use an assistant, but I just can't afford it. But when I look at it, they're not spending any money on salaries, on other people, on help, on leverage. They are under investing in their business. So what it says here is you should be spending 10 to 15% of your GCI on administrative support and 10% on lead generation. Those are kind of the biggest buckets that are investing back into your business. So if you made 200,000 GCI last year and you didn't spend 20 to 25,000 on administrative support, you're not investing properly in your business. Same thing goes with lead generation. If you made 200,000 and you didn't spend 20,000 on client events or leads or any of those things that are going to help you with lead generation, you're not investing properly in your business. We talk and we spoke the last time a bit more about what does cost of sales mean, et cetera. The fact is, your cost of sales might not be 30%, because depending on what leverage you have on the sales side, and when it comes to the spending 30% of investing back into your business, that's at any level of production. You should be spending 30% everywhere.
You know, Katrina, I realize a word that we have said a lot, and we're kind of oblivious to it actually, is we talk about a business. You could be a real estate agent for many years and not care at all about any of the advice that we're giving here. Mm-hmm. I came into being a real estate agent with a background as a CPA, Katrina came into this business having her MBA, and an area that we probably have a real passion for is this is an amazing hobby. Some people have it as a hobby. It can be an amazing career. It can be a tremendous business if you will take the steps to treat it like a business. And most of our colleagues in the industry, they don't. But if you find yourself in rooms of people that when they look in the mirror, they don't just see a real estate agent, they see a business owner in the making, somebody who's growing to run a business, then you have conversations and your language changes and you talk like a business owner. You just so happen to have a business inside of real estate. So when we talk about admin or sales leverage, I mean, I was having a conversation with a gentleman a couple of days ago, who, by the way, great agent, really, really high numbers. And he'd been an agent for about 15 years, had struggled for 15 years ever building a team. Now, it's not that I care about building a team, but I really did wonder how much time he was able to spend with his family, how many vacations he was able to take. Did he feel like he owned this as a business, or this thing owned him and it kind of was a ball and chain? That's usually when people end up just wanting to get out of it. So asking yourself these questions: what was my GCI this past year? And how much did I spend on lead gen? If your GCI this past year was $150,000, we'll use $100,000, and you didn't spend $10,000 on lead gen, then what we know is you took the harvest from last year and you didn't put enough seeds set aside to have a harvest next year. Now, you might get lucky. You might have 2 good years of harvest. But if you can do that over time, you're not going to end up having a flourishing business. Now, if somebody said, "Why I made $100,000 last year and I didn't have any admin leverage, I did it all myself," and they're so proud of themselves for this, what would you say to them about that?
I would say you were it. That there's high dollar productive activities and lower dollar productive activities. And when you went and you put on those lock boxes and the sign writers and dropped off the booties and all of those things, if you could pay a 20-year-old $20 an hour to do it, you are selling yourself short. That there's this space. Like I was speaking with a colleague the other day about Uber Courier. Do you know about this, Seth? Uber Courier?
I mean, I haven't used it, but I'm like, my God, didn't we like literally hire people to do about what you're going to tell me right now?
Yep. No, there was an agent who was had a little old man listing client. This agent was on vacation and called me and said, "Hey, could you sit down with him? Could he meet you in the office and go through the paperwork?" I'm like, "I'm booked solid, but you could always, I'm happy to highlight it, overnight it." It was going to cost $50 to overnight it. $50 to overnight it to this little old man. Guess how much costs Uber Courier? Take it there and bring it back. $30. It was amazing. Wow. And the idea of how much just because you can does not mean you should. And that's something that I want everyone to think about, that there's so often they're like, "Well, I can just go pop on the lockbox. It's not a big deal." Just because you can doesn't mean you should. And if it took you an hour round trip to get there, what could you have done in that hour that you might not say? You might say, "Well, I don't have any admin leverage." It's because you are the admin. And did you sign up in real estate to be an admin? No.
Yeah. And then sales leverage, probably another area. By the way, if there was an order on this probably is in order: lead gen first, then admin leverage. And admin leverage could be contract to close support. Like at our brokerage, when a new agent gets going, we give them a lot of admin support. In a way, it's like some of them are probably watching right now. Like, we don't even give them a choice. We want them to like get so used to it that they start thinking like business people right away, and they want the support. Now, you got to know how to do it. You don't want things being delegated that you don't know how to do. That's kind of a different problem. But sales leverage is different. Sales leverage is maybe from time to time you're out of town and you need somebody to show properties for you, or you need somebody that is also skilled. But I think showings would really be the one that would come into play here. And as you start to cross over the I don't know $100,000, $150,000, $200,000 mark, if you will set a little bit of money aside to just take some of this off of your plate. Like I was coming back from a cruise a couple days ago, and unfortunately, the way I was coming back was on day halfway into a buyer's trip that they were in town house hunting, and I felt really bad. I mean, I literally thought, "What's the cancellation policy on this cruise?" I'm like, "You're crazy. Somebody else can show them houses on day one. you can show them houses on day 2 and lock it up. And that's exactly what happened. I paid somebody to show them on day 1. I didn't feel bad about it. I went and showed them properties on day 2. We got them into a house and things are good. Any last comments there?
Yeah, there's a gentleman in our brokerage who is a solo agent who's going to sell 70 houses this year. And one of the things that we worked through this year is how can you do that or more while working less? And that's all about what does that leverage look like?
I love that. All right. So mistake number 7, they don't separate above and below the line expenses. And then they blame their business for below the line expenses. So I guess first off, we kind of have to explain this a little bit. How would you explain above and below the line expenses?
Part of a really great tax strategy is to tell Uncle Sam you made as little money as humanly possible. And with legitimate business deductions. I'm not suggesting you try to say something was a business deduction when it's not. And when that person went out and got that BMW for $100,000 instead of just riding around in their old Hyundai for a while, could they call that a business expense? Absolutely. And is that something that they should say, oh my goodness, I didn't have that 40% profit margin in my business because I bought a $100,000 car? No, that's where the difference is. There's all of the expenses that we have that we're deducting from our taxes. And then there's the ones that we have that we're like, these are the things that are like the non-negotiable, absolutely needed to have these business expenses. Like, for example, you hire an administrative assistant. That person is absolutely going to be above the line. Whereas that, I've used this example before, the 100,000 whatever you spend on training in a year, that might be below the line, even though it absolutely is a business deductible expense.
Yeah. So first off, let's explain where this came from. So above the line, below the line is a phrase that we got because we own a Keller Williams brokerage, and there's particular accounting that we learn inside of this. And one of them is there are some expenses that as the owner of a brokerage, you can kind of deduct anything you want for purposes of taxes, as long as it's tax legal. But there are certain things but when we calculate sharing profits back with the agent, there are certain expenses that if you want to have that expense, it's below the line. Meaning we calculate the profit share first. Go ahead, Katrina.
Just a really good example is Seth Daly, who is the main owner of the business and runs it, has a salary that he takes from the business. And there's a certain amount that's approved. Like could he pay himself double that salary? Of course. He's the owner of the business. He's entitled to do to run that how he wants to. However, if he was to do more than what's approved from Keller Williams, that would then go below the line, which means we would pay out profit share first. I think that's a really simple example for people to understand.
So think of it like this. Think of it like if you're a solo agent, there's some stuff that are owner perks. Like if you had an employee and you were going to send that employee to a conference and you said, hey, meals are on me, you might expect them to go spend whatever they're going to spend on dinner. But you might go to that same conference instead, and you might go out to the nicest steakhouse you can find in Chicago because you've never been there before, and you just want to do it up. Now, no problem. But if at the end of the year, you find yourself in an office with your coach or leadership, and you're like, this industry, it's so hard, and it's so hard to make a profit. And we're like, really? Show us the numbers. And all we see is like what almost looks like this foodie traveling the world, going to conferences. We're like, you got a pretty good life. You didn't need to eat at those restaurants. I'm glad you wrote them off. You should, in my opinion. And those are, in our minds, owner perks. Consider those below the line. So this, by the way, is why when we mentioned two business credit cards, Seth Daly uses one credit card for above the line, my Bright MLS monthly expense or quarterly expense, and another one for that steak dinner in Chicago. Both of them flow through to our tax return. I just want to keep them separate in my mind.
And a good rule of thumb would be if you had an employee and they swiped the credit card and you were okay with it, it's probably above the line. If you would be like, what in the heck is this? That's probably below the line.
Yeah, there you go. All right. Mistake number 8, not keeping score regularly. P&L review monthly. And Katrina, I was thinking about this today. I mean, we're talking about business, but I'm going to give a very personal example here. So I have a bunch of rentals, and one of them that I've had really, really good success keeping rented, November 2024, 2025, it didn't. And I'm super frustrated by it. But here's what I noticed. In the last couple of months, I was looking at the numbers like every couple of days, certainly once a week on these rental properties. You know what? I have not looked at it in the month of November. Now, you would think, I'm telling you, it's not rented. So you would think that my brain would like look at it more often. And that's maybe what it did at first. Like it occupied a lot of energy. Why is it, Katrina, that when it's not going well, I actually bury my head in the sand?
Out of sight, out of mind. Out of sight, out of mind. If you can almost pretend, you will hear about this with people. Do you remember Screech from Saved by the Bell? He ended up dying of cancer, not because he didn't realize he had a tumor, but because he thought, if I go to the doctor now, it's real. That there's so much of, we have this mindset of, if I don't think about it, if I don't look at it, maybe it's not real. And it absolutely is. And the more that you look at it and just accept the fact that something might not be going the way that you want it to, the more you can control that and actually come out the other side more unscathed than you would have otherwise.
Yeah. Yeah. And by the way, I'm looking at the chat here while you're sharing. Gary made a comment in Texas, assistant or Uber can't go pop a lockbox. Yeah. Isn't it crazy? One, there are so many rules. And I'll tell you this, Gary, I would never disobey a rule. But I'm very clear on when rules are written viewing me as a business person and giving me autonomy, and when rules seem to want to treat me like an employee. And I don't take kindly, and I will look for any option I have to treat myself and be treated like a business owner. So you and we're on the same page there for sure. So yes, there we go. This is Seth not looking at his expenses in November. Also, Screech. That's a terribly sad story. So what do we recommend? Review your P&L monthly. Use so review your expenses and your income monthly. We kind of have an income tracker, and then the way that we think about an expense tracker is we kind of take those, especially the above the line ones, the ones that should be pretty predictable, and we look at them every 30 days when we are at our best. We are not always at our best. Okay. But this has been a lesson inside of having a Keller Williams brokerage. Every 30 days, we do what's called a hard close on the books. That means it literally happens every 30 days. We don't wait 33, 35. Oh, this month got busy, we'll just do it next month. There's accountability to do it every month. And it is a best practice to have your financial house in order. And then there's this phrase, use the MREA. Remember, that's this book here. Use the MREA chart of accounts. That's a fancy phrase for saying, call every line item, listing income, buyer income, rental income, referral income. Call them the same things every year. You don't wing it one year and then call the expenses something different the next year, and follow the chart of accounts or that Dewey Decimal System that they have inside of there. Anything else you add?
And that simply makes it that if somebody comes to me and is like, hey, can you look at my P&L and see where I am? If they're following the proper chart of accounts, I can help them understand, hey, nope, your cost of sales is high, your cost of sales is low, whatever that looks like. And if they're following something different, I can't compare apples to apples when it comes to their business and others.
Well, and you're telling them it's high. So that can mean two things. It's high compared to you last year. That's why you want to stay consistent. But she's also saying it's high compared to your colleagues, the industry, the average millionaire real estate agent. So that's what we would call a benchmark.
Yep.
So love it. All right. Mistake number 9. Talk to us about this one. We kind of similar to the conversation before.
Yeah, but confusing commission checks with a paycheck, that it is absolutely not your money. It is not your money. It is your business's money, and your business has expenses and your business pays taxes. And so the idea of having those separate accounts, but when the day that you get a commission check, that commission check is not, oh my gosh, I got $10,000. That's going to cover my mortgage for the next couple of months. You need to make sure that you are pooling out the correct money for those other pieces, and having the numbers in your reserve accounts to be able to sustain the business and sustain personal when there is a downtime. But it is absolutely not a paycheck.
Yeah. Katrina and I were reviewing an assessment that we have inside of our company called the KPA. It's a personality assessment. And one of the things we realize is that we are both very spatially
spatial visualization
spatial visualization is the term, and we both score very high on that. One of the impacts of that, and probably one of the ways that it serves us well, is that like we think about things and we almost like literally visualize them. In fact, when I talk to you, you guys will often watch me be like, it goes from here and then it does this. I literally, in my mind, I have probably like 3 boxes on the screen and I'm moving something along. Well, bank accounts are a form of sort of spatial visualization for your money. And there's times that I'll put money into one account, and then literally 2 minutes later, I'll move part of it to another account, and then I'll move part of that one to another account. And it's like it's cascading down. And you might be like, well, why don't you just go straight to where you wanted to end up? I'm like, because I want to actually watch this process flow. And yeah, when money comes in, you want to watch the flow of money. Commission dollars should come into almost a holding account inside of your business. And from there, part of it goes to personal, part of it goes to taxes, part of it goes to operations to fund the business.
Mm-hmm. Absolutely.
All right. So commission checks are top line revenue. Set aside money for expenses. Remember back to, I think it was mistake number 5, a pro forma your budget to reinvest. So if I know that our monthly expenses for the team are $10,000 a month or $20,000, we'll say $10,000 a month, and the first commission checks come in and it's $11,000, I might take the first 10 of that 11 and set it aside for next month's expenses or for that month's expenses. But setting aside money into your business for the goose that lays the golden eggs, it's the most important thing you could do and the biggest mistake we see.
Coming up here in a couple of months around February, Seth and I are going to get a bill for errors and omissions insurance. And it is a very large bill. And the money will already be there because we have a specific account that we put money in every month so that when the bill comes due, we're not like, oh, shoot, we have to put it on a credit card and pay it off. We know that bill is probably going to be around 30 grand. So we're going to make sure that there's at least 30 grand in that account when that bill does come due.
Yeah. Yeah. And then mistake number 10, miss out on tax deductions. Good news is you're a business owner. And as a business owner, you get several really great tax deductions. This is not comprehensive at all, but here's a few that you want to think about. Number 1, the Augusta rule, which by the way, Katrina, like you need to take advantage of this year. Have you? You do? Okay. Like the Christmas Adam party. I mean, this is totally an Augusta rule. Let's go. All right. Explain the Augusta rule.
So the Augusta rule was actually because of the Masters, where it's in Augusta, Georgia, and there's not a lot of hotels. So people are like, well, can I rent out my house? And essentially the Augusta rule is a tax deduction of you can rent out your house and the income that comes from that is tax deductible.
Well, here, let's be real clear. Y'all, guess who owned houses in Augusta, Georgia near the Masters tournament? A bunch of congressmen.
Yeah.
Right? This is what happened, right? So you got politicians own properties and they want to rent it out. How long is the Masters? I don't know, but it's less than 14 days. Mm-hmm. So here's what they said. Let's carve out a provision in the tax code that says we can rent these houses out for up to 14 days. And the income that we get from it, we don't have to declare as income. Mm-hmm. Okay. But any expenses that we have on it, like we can still declare. So that's how it started. It was not having to declare the income. But then the difference is, and now go back to about rule number 3 of setting up an LLC, the business. So Katrina's business can pay Katrina, the person, to rent out her house. So the business has an expense. Mm-hmm. Now there's rules on how you do this, but the business has an expense. But Katrina, the person, because of the Augusta rule, less than 14 days or less during the tax year, does not have to declare the income. One of the greatest rules, and I can't believe I didn't learn about it way sooner. Hire your kids. Number 2, there's always here's the general rule. There's always a limit to how much somebody can make, and they do not have to. It does not trigger them filing a tax return. So eyeballing it, it's around $12,000 a year right now. So if anybody, this doesn't have to be your kids, right? But understand, if somebody makes less than $12,000 a year, no tax return is due. Check the current regulations for it. So if
FICA taxes apply.
Yes, that's right. But what doesn't apply is federal income and potentially like state income tax. So there's a huge shift between making, I mean, it's not actually a huge shift, but that's the number. And then no tax return is due. So what's really, really common, and really you could do this even if you paid more than that amount, is to hire your kids. Now, some of you could hire kids. I mean, they might not have gotten hired by another agent to do their mailers because they like to do it while they watch TV, and no other agent allowed that. But you're like, you got the perfect boss right here. I'm literally going to let you fold these mailers while you watch TV. It's a win for you. It's a win for me. And we pay our kids to do things. If you got a baby, some of us in our brokerage, you got a little baby. That you're like, what can the baby do? They can't fold mailers yet. Their hands are too small. They're an amazing model, right? Mm-hmm. That is actually a payable gig. So there you go. There's some examples. Section 179, the 6,000 pound rule. The basic idea there is large weight vehicle, and the fact that can it all be deducted. And there's some shifts that are happening there. And then lastly, make sure that you're maxing out retirement contributions. There's go study Chris Bird. Go Google Chris Bird, and anything he puts out there on the internet, go watch it. He's got some great tax advice. So that's who I learned a lot from over the years. All right, you ready, or anything else you want to add on?
Let's go.
Boom, personal finances. So guys, everything we've covered so far on business stuff, and yet the personal finances, we'd say it this way. One, if you're a solo agent and you don't have your personal finances in order, it's going to impact your business. Number two, if you're watching this and you run a team and you're like, Seth, that was kind of I knew most of that stuff. I only got a couple new things. All right, now here's my next comment. Does your team know everything we're about to do? Because I'm telling you, if I look in the mirror, not everybody on my team does. Yeah. You're going to see some things on here that of all of my employees, I'm like, no, I don't think all of them are doing this. Well, there's an opportunity for me as a leader to bring that teaching to my team. And number three, these are certainly valid teachings that we could teach to clients inside of our database. What a valuable way to give back to our buyers and sellers. So, hey, repurpose any of this content if it's helpful and improve on it, and then send us to the improvements. So mistake number one, personal finances, not having a household budget. Katrina, what would you?
I think credit cards have made this even worse because back in the day, you got a paycheck, you cashed it, and you're like, I'm going to pull $400 out from the bank. And when that $400 was gone, the $400 was gone. And because we have credit cards, like I'm like looking in the mirror here, we always pay the credit cards off, but I'm not paying attention to, hey, was this in the budget? Like, how have we exhausted the budget for eating out yet this month? And we're looking at much more in arrears than thinking about forward thinking. So if you're the kind of person that's like, hey, maybe you need to go down to cash. Maybe you need to say, okay, I can spend $400 eating out this month. And when that $400 is gone, it's gone. And you put that money in your wallet and you see where it goes. And it makes a huge difference if you're paying attention to it ahead of time and not just looking at it in arrears.
Well, and the idea is anytime you want to pay more attention to something, make it harder to do, right? This is the whole put the cookies on the top shelf or outside of the house if you want to make it harder to eat them. But last thing you want is for them at eye level. And number two, have some friction in the process. That's where the cash came into play. When Dave Ramsey's like, put cash in an envelope, he's not unaware that that envelope could get lost or stolen or something else. But he's literally trying to create friction and to make a process harder. The problem now is between Apple Pay and everything else, it's so freaking easy to spend money. And this is why companies get valued so high when they get you on a recurring revenue. It's why their value goes to 40x, right? Instead of 10x is they know that if they can get you paying something monthly, and we all do it. Yeah.
I heard a really good tip from somebody who's a budget expert. And what they said is that you should have, for those who are addicted to a credit card, getting off of that, getting a debit card, but having two personal accounts. One of them is the account that all of your those monthly recurring expenses are on: your mortgage, your insurance, the cell phone bill, the things that are going to come out every month. And then say that's $3,000. You have $3,000 in that. Say you get paid $5,000. The other $2,000 goes into this other account. That one is the one that has the debit card. The first one doesn't have a debit card. The second one is the one that has a debit card. And that way, yes, you might swipe it, but when that money is gone, as opposed to a credit card where you can spend money that you don't have.
It isn't there. Yeah.
And that's kind of a little bit of a way to hack the cash system without carrying cash. It's not quite as good, but it still gives you some of that friction and that accountability.
Yeah. So by the way, if you go to this QR code, I think there's a budget worksheet there. Feel free to use it if it's helpful. If you can't get it, shoot me an email or reply to however you got onto this, and we'll try and get it to you. But here might be some buckets you think about. One, recurring monthly expenses, your mortgage, your cell phone bill. Number two, day-to-day routine expenses like
Groceries,
gas, groceries. Right, it's going to happen. It's going to happen every few days, perhaps. It is routine, as opposed to non-recurring or random spending. And what you'll find is that even things that are non-recurring. I mean, I'm going to use a vet bill, non-recurring, random. A hot water heater goes out of your house. What you'll find is that the longer that you track non-recurring and random, you'll find, well, it does recur. It just it is. You got to look at it over a longer period, and then you try to budget for it accordingly.
Jason and I have a category called non-budgeted expenses. It's not in the category 1 or 2, but it showed up. We needed a new hot water tank.
Yep, exactly. So some thoughts to do. Recurring monthly expenses. Make a list of your bills. Put them by amount and due date. Put them in due date order, right? From the first of the month down to the end of the month. Helpful way to organize, though. Day-to-day routine expending. Determine exactly or a ballpark of what you need to spend per pay period. How much are we going to spend on gas or groceries per pay period? Transfer set amount to your spending account or withdraw cash. And my guess is there's less and less. That cash is just going out of style. Maybe it'll come back, but I don't see it happening, right? So, but as much as you can then segregate stuff by account, it'll be better for us. Non-recurring and random expenses. Determine an average of these expenses. Set up a savings account. Transfer set amount to that account on a set day each month. So when we think about our random household expenses, by the way, a rule of thumb that we've used over the years is we take our house value and we take 1% of that amount. And we just think 1% a year in household expenses for the random hot water heater or this or whatever. And maybe you get by a couple of years and you didn't spend 1%. But if you were saving 1% a year, you're going to have a year where
you need a new roof.
It's going to be a country western song, and just get ready for it. All right. Your monthly spending then starts to look closer and closer to the same. Pay your bills, transfer, withdraw monthly spending budgets, and save for upcoming unexpected items. Types of budgets. Oh, wow. There's a lot of slides here. We got to go. 3 types of budget. Just like we said, kind of good, bad, or probable and worst case scenario. We think about budgets as what's our survival number? What's the number where we're literally head is above water and that's about it? What's our stability figure? And then what is our success figure? And there's times where, because we are funding a business venture, we will drop back from the success budget to a stability budget. And we'll notice that, and we'll actually have conversations. Alice and I will on this, and it's an important number to know.
Yep, tighten your belt.
All right, mistake number 2. Go for it, Katrina.
You have debt with no plan to get out of it. Again, credit cards, cars, your student loans. Like right now, it is so easy to get into debt. Uncle Sam, how many
taxes?
Yeah, they owe so much money to Uncle Sam. So the first piece, you can go to the next slide.
That's okay. And let me just, I will. And here's a question, y'all. Just ask yourself, where in my finances am I flirting with disaster? Whatever comes to mind there, that is, forget what we're saying. Go focus on that.
Yep. And the idea of, and again, this is where I see so frequently that people their business slowed down and their personal lifestyle did not.
Yeah.
In the last several years, the real estate industry has been more challenging, but people who are like, wow, I'm the big stuff in 2020, 2021, when there were so many transactions, who didn't cut quickly enough. If you cut quickly, when things start to slow down, you don't have to cut as deep. But when you continue to live a lifestyle that is above the income that you are bringing into your family, the longer you do that, the more you have to cut. So stop the bleeding, cut the expenses, cut the cards. If you need to go back to the cash method, go back to the cash method. And then I love Dave Ramsey's debt snowball, which is pay off the smallest debt first, and then take whatever that is, put it towards the next, and just really work on getting getting all of that debt off of your finances, because you can live in that survival world for a long time and get rid of that debt. And as soon as that's gone, even with the same amount of income, you're at stability or even success because you're not spending all of that money on interest.
Yeah, yeah. And there's kind of an example of how the debt snowball works. Y'all can look at the slide and go back to that, but it rolls it forward onto the next debt. There are some other ways to do that, right? So Dave Ramsey's kind of a debt snowball guy. Robert Kiyosaki, last time I checked, it kind of taught pay off whatever the highest payment is. Focus on that first. Pay extra towards that one to get the highest payment off. Susie Orman, is she still around? I don't know. Pay off the highest interest rate first. And then I like this one, pay off the one with the most emotional baggage. We had, Alice and I had some expenses that they weren't high and they're actually super low interest rates, but they reminded us of some stuff that was just like emotionally really heavy. And so which debt creates the most stress or anger? Pay that one off first just to get it out of your life. All right. Pay off full balances, then pay off balances in full each month with auto payments. All right. Mistake number 3, not having a plan to pay yourself first. So save and invest. Another way that we talk about this is, we'll talk about this as taking chips off the table. Mm-hmm. So sometimes people they'll get money and they do great. They'll invest it back in their business. And I did this every time we make money. I would want to put it back in the business. Let's hire another person. Let's add some more tech. And I would never like take the profit out. And so we'd wake up 5 years later and Alice was super bitter about my lack of ability to take the profit out and put it to wealth building. So read Profit First and or Richest Man in Babylon. Anything you'd add there?
That's great.
All right. And start early. All right. Number 4, instant gratification financed by debt. Go for it, Katrina.
Yep. Nope. Again, that goes to that swiping that credit card. I think in speaking with lenders recently, the amount of consumer debt that people have is just astronomical right now. And people are living their life on borrowed money, and we need to live our lives on our income from today, not the income from tomorrow. And what it's causing is people don't have money invested. They're not putting anything towards the future. They've got debt on their future. They don't have any investments on their future. And it's a really slippery slope. And
you don't notice it. You don't notice it. It is made on purpose. It is made so easy to do. So what do? Delay your gratification. I may or may not have a daughter that I'm having this conversation with right now, right? Pay in full. Don't finance consumer debt. Dave Ramsey's all debt is bad. There's tweaks to that, and even Dave would have some tweaks, although he's pretty stuck on it. But don't finance consumer debt. At least hold your line right there. Start with a budget and a spending plan. Mm-hmm. All right, number 5, not diversifying their income. I'll chime in on this one real quick. If you have not read Rich Dad Poor Dad, I'd encourage you to read this book. And if there's one slide that has sort of become really famous it's called the cash flow quadrant. It's this idea of he calls it ESBI, employee, self-employed, business owner, and investor. And I think a really helpful way to think about your money is to think about where do you make money in each of these quadrants? Where do you make money as an employee? And if you are self-employed and you literally are not an employee of anybody and you don't, and if that's you, think of it this way. Where do you trade dollars for time? Like if you put a certain amount of time into something, you get dollars back regardless of the result. That's different type of income than the bottom left, which is self-employed. You get dollars for results, whether you're a salesperson and you get it because only when the settlement happened, real estate agent, or you get it based on bonuses. We'll take Katrina's world, right? She gets paid a salary, but also there's some results that come as a result of how did the business do? Think about that in sort of the bottom left. The top right is where do you actually own a business? Not from the tax perspective. The IRS will tell you own a business just because you file the right type of tax return. But this is really a mindset. And if you think about it, where do you own, according to this language, where do you own a system? And or when do you get paid because of the results of other people? You won't shift into that world until you start to become a leader. And then the last column is where do you take some of the chips off the table, pay yourself first, take that profit and go have the money, earn more money. And that's the investor. All of us could actually make money in all 4 quadrants. This is not pick one or the other.
Yep, absolutely.
All right. Well, I'm going to jump past this, but I will just say, if you are like me, you may realize that you go years missing the difference between active income made for the work that you're constantly doing, and what I'll use the word passive income or horizontal income, or income that results by making really good decisions and then letting the money go to work. Some of our best wealth building has come from making decisions and then letting the money go to work. That is the investor side of Cash Flow Quadrant. All right, Katrina, mistake number 6.
This goes into what you were talking about before. Spending is frictionless and savings happens with friction. That idea of the credit card is really easy to swipe, but I got to do something manual to save, make it easier to save and harder to spend. Stop those auto payments. That's a big one, especially for, like, let's take your credit card, for example. Your credit card, you can put that on an automatic payment, but that payment is going to change every month. And you're going to look up and you're like, my credit card bill used to be $3,000 a month and now it's $5,000 a month. Where did the money go? But you aren't noticing it because it's frictionless. So make yourself think about it. And again, if you are paying yourself a paycheck and you're using a software, you could say, I want a portion of this to go into a savings account in whatever you're using, Gusto, ADP, etc. You can say, put 80% to this account and 20% to this account. And then and it becomes frictionless.
Yeah. I bet if we did a poll and we said on here, who has something set up on auto pay? Everybody on the call would say yes, right? If we said, how many of you have something set up on auto pay or auto pay to yourself, like auto savings? We might get 10 or 20%. Y'all, they are smart. The people that put you on auto pay are smart. We've got to outsmart the system. Put your savings on auto pay to make it easier for you to save, and then do anything you can to create friction in the process that force yourself to look at it. A good example for business people, even though they could pay stuff online, they force themselves to write checks. So they're literally looking at the expense and signing it. The further you get removed from your money, you're removing the friction.
And removing friction from savings as well is it's having that savings be at a different bank that it's hard to transfer the money. If you have it,
easy to send it, just hard to get it back.
Yeah, hard to get it back. Like 3 to 5 days is really great because you're not gonna. You've got 3 to 5 days to think about that expense and think about it. Should I actually be spending that money?
I love that. Mistake number 7. We kind of talked about this earlier, right? Mistake is not getting on the same page with your spouse or partner on how to handle money. And what we tend to find in most in most partnerships, my wife and I have done some workshops for couples that work together in real estate. And one of the things we talk about is, hey, inside of a couple, there's usually a saver or a spender. Katrina, how is it for you guys?
I would
actually, you guys are kind of balanced.
We're pretty balanced. We're pretty balanced in that, which is really great. But I see the same thing with a lot of families that there's that person who wants to go out there like, oh, make the more money later. Let's go do it. And the person who doesn't want to spend. And the thing is, as a family, Jason and I have actually erred on the side of not spending. And we've realized more recently in the last couple of years how we're robbing our family from other things by not spending the money. So for example, we went away, just the two of us. It's really important to invest in our relationship, but it just so happened we didn't have any family members who could watch the kids. In the past, we would have canceled the trip. This time, we're like, you know what? Let's find somebody who we trust who can watch the kids, spend the money so that we can invest time otherwise.
Yeah. So for the person that is a spender in the business, having an agreement with your partner to take chips off the table and put it into the household and let the household invest it, that's huge. And same thing, don't go raiding the family emergency fund for the business. You do need business reserves to start the business, and then the business needs to work for itself. You just don't want to pull all of the assets out of the business and not let it reinvest. So if you cover everything that we talked about in the business money, this should take care of itself. Mistake number 8, not having a scoreboard. And if there's 2 that you might want to look at, Kubera is one I've used before, and then Monarch is a new one that's come out. And there's probably a bunch of others, right? But tracking your expenses every month And number two, tracking your net worth every month. That's probably one of the greatest tips that I was given and that I pass along, is looking at your net worth every month. Even if right now you look at the number and you're like, is this supposed to have a dash in front of it? Is it bad that the number is red? Isn't that yeah, that means it's negative. Don't worry. Go for a smaller negative number. Then it will become positive, and then it gets bigger.
Yep.
All right.
And as far as tracking expenses, I know a lot of people use Dave Ramsey's Every Dollar as a more automated personal expense system.
Love it. Love it. All right. Number 9, all offense, no defense. And the basic idea here is you're so focused on making money that sometimes the most catastrophic things that will actually take you out, it's something that was only solved with insurance. So here's a list. Take a look at these, figure out which ones you have, which ones you don't. If you don't have it, it might be the next one for you to get, right? Home and auto, of course, health insurance, life insurance, term. Now I say term because for me, whole life insurance, which we have some, but we think of that more as an investment product. Then short and long-term disability. I remember the year that we added that inside of our world. We added it for ourselves, added it for Katrina, added it for the team, and then a general liability insurance policy. So take a look at these. If there's any that you don't have, work on adding them. And mistake number 10, not having a team. What would you say when you kind of look at this, Katrina?
You do not need to be the smartest person when it comes to all of these things. You just simply need to have access to the smartest people. Earlier, when we were talking about starting an LLC and should you be taxed as an S Corp, Seth and I don't even answer those questions for ourselves. We go talk to somebody smarter than us. That we've got different pieces. Jason and I were just when we were talking about our family's finances. So we think that the next coach that we're going to have is a financial coach in our world. So like, hey, not because we don't know what to do, but because we need the accountability from someone that it makes it a little bit painful. We need the painful accountability. So who is on this list that you need to have on your team? And if you don't have them, feel free to reach out to us. We're happy to make a recommendation as well.
There we go. So I think that's it. I mean, we're at time. We're 3 minutes over. If people have questions, throw them in the chat. We're happy to stay on for a minute or two to answer them, or we're not hard to reach. There's our contact information. Reach out to us. We'd be honored to answer questions. Some of you are probably texting right now, which is totally fine. Katrina, any last words that you want to share? We're kind of back at this, right? We've done these before. We're kind of getting back into a rhythm. We'll recreate some of the content we've taught in the past and reteach it, and then we'll bring some new stuff. So stay tuned. We'll be in touch in December with at least one, probably just one in December.
Yeah.
Any final words you want to leave people with?
Go out and conquer.
Oh, okay. There you go. And cut up your credit cards. Y'all, here's what I would say. I don't know where you all learned about money, but I can tell you, I did not learn about it growing up. And there's probably a couple topics that are really, really hard to talk about. I think money is one of them. And money is good for the good it can do. But there can be tremendous baggage around this concept. And there can be tremendous shame if there's decisions that you've made in the past that you're trying to dig yourself out of right now. My biggest hope for anybody on here is that if you're watching this and you're like, I need to bounce some ideas off of somebody, and I don't really know how to untie the knot that I found myself in with my finances, that the person that unties the knot, they're just going to help you think about it differently. If we can be a resource in any way for that, there's no shame in it at all. We want you to thrive financially and in life and in business. And if there's a way that we can support you in that, you know how to reach us. So we appreciate you all, and we'll talk to you soon. Happy Friday.
Happy Friday.